Hello and welcome to American Property Partners, and this is the webinar on cash flow killers. We're going to go ahead and get started. Well, thanks again for joining us for our webinar today. In this webinar, we're going to be going through 9 different challenges you can face when investing in U.S. property. We refer to them as the cash flow killers. You know, the purpose of this webinar is to accomplish 2 things. Number 1, to provide you with value by sharing with you the 9 things you need to be aware of when investing in the U.S. And number 2, to share with you how we approach each and every one of those things to mitigate your risk in each investment. Now, I'll share with you, I've been selling real estate for the last 15 years. I've been to numerous sales courses over the years. In every course, they teach you things not to talk about. They say, don't talk about religion, don't talk about politics, and don't tell horror stories of terrible things that have happened in your business. Well, in this webinar, we will not cover religion or politics, but we will break it, one of those cardinal rules of selling. We're going to tell you the worst things about investment property. We may even try to scare you a little. We are doing this not because we don't want you as a client, but because we want you as an educated client, a savvy investor, one that knows the risks so you can appreciate the reward that comes with it. So, without further ado, let's go ahead and get started. Well, my name is Mikesell, and I've been investing in the United States for the last 16 years. I grew up here. I've invested actually in 5 different states around the country and bought roughly 500 properties, which I've renovated, leased, and managed. You know, despite my experience, even I get caught every once in a while by one of the 9 things that hurt my investments. Today, I want to share my experiences with you. You know, there's no easy way for me to do that except by sharing the challenges with you and showing you how our experience here at American Property Partners contrasts just that. And, of course, sharing with you the intentional moves we make to make sure we are helping you into a sound investment. So, how does it all start? Location, location, location. If you're able to join us for our last webinar, you may recall us discussing the 3 famous real estate words used by most any person who has ever had a conversation about real estate. Location, location, location. If you remember, we discussed this as location within the world, location within the country, and location within the city you're investing in. So where in the world are you going to invest? Where in that respective country will you invest, and where in that city will you invest? The location has everything to do with your goals. Location is the reason you're on this webinar. Location can determine your financial future, the amount of cash you have when you retire, the caliber of your investments, the quality of your tenant. Location is absolutely everything. So let's start with the location. I am showing you 2 pictures right now. The left picture, let me tell you a little bit about that. That house was built in 2008. That house it's relatively new construction. And the house on the right was built in 1958. The house on the left is rented for $875, right $850. 3 bedrooms, 2 bath, or both of them. One rented in 3 weeks, one rented in 4.5 weeks. Not a lot of differences. You see the house on the left is sold for $74,000, and the house on the right sold for $91,000. Well, what do you think so far? Which one would you buy? What is your best guess? You may have guessed it right. If you assume the house built in 2008, renting for $50 more per month and renting 1 week faster and selling for nearly $20,000 less was the better of the 2, you actually assumed incorrectly in this case. Let me tell you about these 2 houses. Both of these are real houses. One sits in a location that is on the edge of one of the worst areas in this city. The other is a strong area that happens to be experiencing tremendous capital growth. You know, there's a large difference between cheap and affordable. There's cheap houses all over the place, some in small towns, bad neighborhoods, mining towns. You can always find a cheap property. Cheap is different than affordable. A cheap property is relative to the market. A cheap property normally indicative of an area that is lower socioeconomic neighborhood, an area that you'll experience more vacancy and more maintenance. So how do you know what location is the right location? Locating the property that is affordable and not just cheap. Well, the signs are the same. The cars they drive, how they take care of their yards. When we are identifying properties for our clients, we ruthlessly consider all of these things. We cannot tell you what you should and should not be comfortable with, but what we can tell you is the signs of an area that is not doing well. We are looking for areas that are not just areas that tenants are attracted to, but homeowners are attracted to. Areas that offer good street appeal, that you'll be able to sell down the road. Location is everything. So, we've all heard never judge a book by its cover. Equally, we never judge a property by its picture. So what does the initial renovation look like? Initial renovation is one of our cash flow killers. We've all hired contractors to do various projects for us. I had a good friend who used to say about contractors is, these are guys that come late, leave early, and steal from you when they're there. This might be a little bit of a pessimistic view, but also one many of us have probably experienced. We know projects always seem to cost more and take longer than planned. We know there's always something else that comes up during a project. Handling a renovation when you're there every single day comes with its own challenges. Handling a renovation from afar comes with, obviously, even more challenges. So here's the good news to start out with. When you are investing with American Property Partners, you don't have to deal with contractors. You don't have to deal with the project. You don't have to sit through a renovation on a house. All of the houses we sell have already been renovated. However, a renovation to you and to me could mean something different. So let's go through that. A renovation to some could simply mean new paint and new carpet. I had a client not long ago, a few years back, who bought a property from another group. This group claimed the house had just been renovated. They renovated with new paint, new carpet. The problem was the carpet was installed over a floor which was rotting, and the paint on the walls had termites actually underneath them. So, how do we prevent this from happening? We obtain building inspection reports on all the properties to start out with. We ask specific questions when we're looking for properties that have had more than just lipstick put on them. We're asking about the things that really, really matter, the mechanical items, the heat and air con, water heaters, roofs. These are the things that will cost you real money down the road. These are the things that if they were not handled during the initial renovation have the potential to threaten your cash flow. So that's how we handle renovation. So what's next? What is the next cash flow killer? It's knowing your numbers. So here's the deal. Anytime I'm evaluating an investment property, it's important to know the numbers on the property that you're looking at, and initially looking at, you're looking at two primary numbers: the purchase price, of course, and the amount of rent it is generating. These are the first two looks at every property. You look at these two to determine if you want to bother looking at this property any further. The reality is, if the number is, if the property is vacant, then it does not have a rental number. There's no number to attest to a vacant property. If this property is vacant, then there's no way it can have a true and honest income number. Anyone can make projections, but a true and honest income number only comes when a property is occupied. How can you possibly evaluate a property that has no income? Yes, I realize we can all take educated guesses. We can look at resources online, looking at other comparable rents, but we still don't know the true and honest number. The fact is, the only way to truly know is to make sure that we are buying properties with tenants already living there or lined up to move in. Why would you buy a property any other way? Would you never consider buying a property that only had expenses to offer and no income? Nobody would ever consider buying a property that only had expenses and no income. In every city, the properties we work with our clients on come occupied with tenants living in the properties and most importantly, paying rent each and every month. No one is saying that these tenants are perfect or that they're going to pay perfectly, but what we know is that they chose this particular property. They put a bond down, and they could lose it if they did not perform on paying the monthly amount they agreed to. Now, and only now, we have a true income number, a real number to work off of, to evaluate all the expenses against the property to make sure the numbers work. So let's look at other numbers that matter now that we have income actually coming in on our property. It's a good thing. So, I was recently reading Real Estate Magazine, and in there was advertising a 34% annual return on capital investment. What an awesome return, I thought. Now, I'm not a person that believes just because something is too good to be true that it does not make it real. I prefer to evaluate each investment for what it is and determine if it is bunk or if it's a real investment. As it turned out, this one happened to be bunk. The 34% was real if you did not factor in the majority of the expenses that were going to be associated with this property. So, how do we know what our net number is on a property? Look, you can come up with all the expenses you want. You can evaluate these investments any way you want. If you believe your spreadsheet is the best creation and the best formula in existence, then use it. All we ask that you are consistent with each and every property that you're evaluating, whether that property is in Australia or the United States or Japan, that you treat each property the same in the way that you evaluate the numbers. Let me share with you how we evaluate each investment. We look at net return on investment, your ROI. This is your baseline comparison for all your investments, not just your US or Oz investments. If here's the deal. If you have a family member ask you for a loan so they can start a brand new business and they offer to pay you 5% interest, that is your ROI. If you can invest in the stock market and make 6% after all your expenses are deducted, well, that is your ROI. If you invest in real estate after you back out all your expenses, whatever you are left with at the end of the year, that is your net cash on cash ROI, your net cash on cash return on investment. This is your best line of comparison for all your investments. Now you can move forward confidently knowing you are investing your money in an investment that will provide you the highest return on investment with the same balanced risk. So how do we get the ROI number? Well, first we add up your expenses. We add up your annual mortgage if you've got financing, your property taxes, which is your council rates, insurance, property management, vacancy and maintenance allocations, and whatever is left at the end of the year after all those expenses are paid, that's your cash flow. So once you have your cash flow number, you divide that by the amount you actually invested in to get your ROI. So for example, if you invested $50,000, then you figure that net cash flow amount against your $50,000 invested. So for example, if your net cash flow per year is $4,000, you divide $4,000 into $50,000, the amount that you invested. We run these numbers with you and for you for every single property during the property evaluation process. We run these numbers so we always know what our net return on investment is, and so you can rely on it and, of course, build your portfolio around it. So what drives return on investment? Nothing drives it better than a good property manager. Property management is one of these expenses where there is a need for a paradigm shift. I'm sure it's tempting when evaluating property to use Australian management fees as a guide, but when you're reviewing available property from us, American Property Partners, you will see in all the properties, the management fees are typically ranging from 8% on the low end to 10%. This is very standard in the U.S. These fees pale in comparison to having the wrong property manager. The performance of your property is almost in every case is directly or indirectly related to the ability of your property manager. A good property manager determines the tenant who moves into the property, the protocol on the rent collection, the maintenance, the annual inspections, and in some cases even the caliber of the tenant. We've worked hard in vetting out each property manager and understanding the systems and processes that they have in place. None of them are perfect. I wish I could say that they all were, but none of them are perfect. But all of them know how to effectively manage rental property. They know where to focus their efforts and how to manage rental properties effectively. Here, despite our efforts in finding you the perfect property manager, we believe it is still your job as a diligent investor to manage the property manager. If you're not clear, ask questions. If your property manager is not clear, ask more questions. If there's maintenance, understand what that maintenance was for. It is not to be skeptical that something dubious is going on, but merely to keep clear lines of communication open at all times between you and your property manager. So let's talk about council rates and property tax. Same thing here. It is something here that works a little bit differently than the way it works for you. Property taxes in the United States are a lot like the rates you pay in Australia. They vary widely between states and counties. It can't be assumed automatically you pay a certain percentage in one state and that it'll be the same in another state. What we find is if there are certain states with higher property taxes, the income on the property will be proportionately higher to compensate for the higher rates. Property tax in each state can change depending on the state every few years as they reassess the value of the property. Insurance in the United States is similar to what you may be used to. However, we've seen poor insurance decisions turn great investments into nightmares. Because of that, it's because typically insurance nightmares happen because vital things are missed on their insurance policy. For example, the loss of rent clause, flood insurance in a flood zone, or hurricane insurance. If insurance was not important, the bank you borrow money from would not force you to insure it. Insuring your investment correctly is important to your investment, which is why the banks force you to have insurance. When getting your insurance, here's your standard insurance policy will come with what we refer to as the burn down clause and, of course, a general liability clause. About 4 years ago, I got a phone call, and that phone call, I was on my way to the office, and it said, "Hello, are you the property manager for this such and such address?" And I said, "Yes," I responded. "Okay, well, this is the fire department. Your house on River Street just started on fire this morning, but we believe the cause of the fire was a small fan that fell over and overheated and caught a blanket on fire. The whole second level of your home is now gone." Well, as it turned out, it wasn't my home. It was actually a rental property that belonged to one of our clients. With that client who bought that property, we strongly advised her to pay for something called the loss of rent clause. And as it was basically an add-on to her insurance, meaning it cost her a little bit more. This clause basically paid her rent that she was receiving on this property for the next 7 months it took the insurance company to rebuild this burned down property. As you can imagine, our client was grateful. We were so convincing in advising her to get this added onto her insurance policy. She got a brand new house 7 months later. The best part of the story is about 3 weeks after the house burned down, the tenant who actually used to live in the property called and requested that we send them back their bond, their security deposit. We found that very funny, simply, and because the house burned down. And of course, how did we respond to their request for their bond? We said, "I don't believe we are going to be returning your bond because you burned down our house." Pretty straightforward. So, repairs and maintenance. Well, let's see. How do we cover this? Repairs, maintenance, and vacancy. Repairs and maintenance is, this is such an ambiguous category. How much is the right amount to set aside each month? First off, repairs and maintenance are two separate words. Repairs meaning the repair of broken items, and maintenance meaning properly and proactively maintaining before something goes wrong when it needs it. So as it relates to maintenance, a lot of maintenance can be scheduled. A lot of it can be planned for. For example, if you know you bought the property this year, and when you bought the property it has a brand new aircon installed, then you know it will not need to install a brand new aircon for this house for at least the next 12 to 14 years. You can schedule and plan for this maintenance down the road. However, in 7 years from now, as that aircon is a bit older and does not work quite as well, then you can expect to deal with some break and fix scenarios, minor maintenance or minor repairs. As a general guideline, we like to set aside 5% per month for maintenance. I personally like to fund my maintenance account with a little bit of money to start out with, and then just add my 5% to it each month as the rental income comes in, so I always know I'm prepared for whatever maintenance calls to come in down the road. Vacancy, an empty property, nothing hurts more than having zero income come in on a property. That's what vacancy is. It means zero income. This means it's money loss that you'll never ever recover, ever get back. When a property is vacant, it'll already be something that you don't want to be dealing with. However, what makes it tolerable is at least being prepared for it. So my feedback, plan and prepare. All of our rental properties will go vacant. At some point, eventually, all rental properties will go vacant. So be ready. For our vacancy allowance, we also like to factor in 5% of the gross rent each month to vacancy. The average tenant stays in most places for 2 years, bare minimum. The average time a property is or should be vacant is 45 days. So just planning and preparation and allowance for each line item makes each of these investments a little bit more comfortable and easier to manage for you and, of course, your property manager. So here's the thing. We've covered a number of different things tonight that are what we refer to as cash flow killers, things that could hurt your return on investment. There are many strategies we can share with you on working through vacancy, maintenance, choosing properties. We just simply cannot cover everything with you in this format. What we shared with you, we hope will offer the largest cross-section of information that will assist you in your investing decision. Let me share with you my closeout thoughts. My take is this: investing in anything is a risk. There's no such thing as a risk-free investment. If there was, we would all be on that train. Everyone you know would be investing if there was no risk. In fact, I will take it one step further and say, if someone tells you there's a no-risk investment, run. Run as fast as you can. Run away. There cannot be a return without a risk. It does not exist in any country or in any type of investment. What makes each of you here listening great investors is the fact that you are taking the time to figure out what those risks are, evaluating those risks, and making sure those risks are an acceptable level for you to warrant the type of return you are wanting that you cannot get in Australia. So, where do we begin? Well, we start by getting started with American Property Partners. Make your location decision. Decide you are investing in the U.S. From there, we can set up a one-on-one strategy call with myself or Steven. After that, we get to finalize your investment criteria. Decide what the criteria is that fits you the best, what quadrant you're investing in, the area, the type of property, the things that are the most important to you when you're developing your portfolio. Then after that, we do something called the property selection, where we identify a few properties that you like and why, and we start working through the property selection process in extreme amounts of detail. After that, the financing process starts, and you get to begin building your U.S. investment property portfolio. So we've got a couple of workshops always coming up. And we also have a couple of tours coming up here in the U.S. So we'd love to have you at either one of those. And we look forward to speaking with you again. Thanks again for joining us tonight. Have a good one. Take care.